If you look over the last 25 or 30 years, every dollar of debt that the U.S. has taken on is getting a lesser and lesser and lesser amount. We're not even getting a dollar return for it. And then it's interesting, when you go in an exact opposite direction, you look down at Argentina and their debt's been upgraded. You know, they're actually probably doing the right things and really getting tough. And yet ours are getting downgraded and we're not doing the right things. And so I think that's the tale of two countries. And the reason they're running a deficit because they're spending. Unfortunately, it's like a short-term dope addict. And so, you know, you got to back to the real world eventually, but that's the difference. And then one of the difference, you know, in 2011, when they lowered, S&P lowered it, we only had, I think, 78 or 80% debt to GDP, U.S. debt. Now we're 120. I mean, it's a totally different game now. I don't know about that. I just know we look at companies and, you know, one of the things we found when the markets were breaking down, and we run a lot of screens, you know, we got to the point where 12 or 14% of those companies were starting to get in the zone where they were really getting cheap enough to buy, and we did buy some things. But now, you know, just in the last week, we run the screens, we're right back where we were. Everything's totally overpriced. We're back at 22 times future earnings. Now, that's not to say the market can't go to 30 times future earnings, but I'm just saying it's expensive. Most of the companies are expensive, and you have to really be careful of what you buy. If you look at it, they use this narrative to make sure that everybody thinks that, hey, you know, it's like saying, okay, I'm going to cut your leg off, and then you come back and say, well, no, we're just going to cut your big toe off, and you got to feel good about that. See, that doesn't make sense, but it still hurts. But that's the idea of all of this, you know. We're going to go huge and then come back and make you feel better, but it's a tactic. I mean, in the real world, it still has, most of the businesses are still upside down on what they're going to buy, all this sort of thing, just like Walmart last week when the president said, hey, you just got to eat the tariffs. Well, I doubt if they eat the tariffs, okay? So you get into things like that. If you look at price of the S&P relative to forward 12 months of earnings, I'm saying here 22 times, and that's really expensive. I mean, you can't say that's in a zone of a 14 or 15 time multiple where you'd really find things to be cheap, or at least cheaper. Yeah. And we're right back where we were. That's what I'm saying. It's almost like if you'd gone to sleep and woke up, nothing's changed at all. And I don't think people's attitudes did either, by the way. Well, we've said for some times you can't buy the long bond. We've tried to trade that a couple of times the last couple of years and made not much money, really. And we think really the next 5 to 10 years, there will be periods where maybe you get lucky on a trade for 6 or 12 months and the long bond does okay. But as far as just owning it for the long term, I don't think people can do that. I think people have to look at the debt level and say, hey, this thing's out of line. And I mean, they're still selling the bonds, but I think that's the problem with owning the long-term bonds. Well, I think eventually, yeah, you will have higher inflation. Maybe not here in the next 2 or 3 months just because of some of the base effects you're looking at. But when you get into, you know, adding these tariffs on, things that happen, you should get more inflation. Well, let's just say the long bond average is 4.5, 4 3/4. I know it's higher than that right now over the next, and when you buy a treasury, you know, they don't call them, so they're a 30-year hold. And the problem with that is if we think inflation over the next decade will yield somewhere between 3.5 and 5. And if it does, that's not enough of a spread for us to want to own that because that's a losing proposition in terms of the real return, okay? And so you take that real return from that treasury and you have very little left over. I mean, S&P, Fitch, and Moody's are the ones you look to, the big three, so they're already done. I think the biggest thing would be, you know, there's been this idea that if you look at what's in front of Congress right now, particularly the House, that they're going to push that up. Well, there's about 30 of those people that are saying, no, we're not going to go along with that. And so if they hold that up, which they act like they're going to because there's not enough cuts, they're giving too much money away. And if they do that, then the Treasury is going to have to come back then and issue more treasuries than they probably wanted to, because you're going to be in a situation where you're up against the debt limit and all of a sudden you go into that shutdown mode again, and they're not going to shut down, but they're going to, talk about it. That to me is the bigger question here rather than what the agencies just did. We're really trying to find companies to buy, and the only reason we carry the treasury short term is because we're looking for other things to buy, and that's a good place for us to hold money in the short run. We're not really trying to worry about the interest rates come and go, and we're getting paid a nice return on those treasuries right now. And if in fact that Treasury rate goes way down, that probably means we're in a recession, and then we'll have more things to buy, if that makes sense. It's an offsetting item. What we want to do is buy more companies. We want to buy more things that we really, really like, and we buy some. But when you use that money, that's what we use it for. We don't really use it to trade the Treasury curve or anything like that. I mean, I'll give you some examples. If you look at, oil in the last 3 years has gone from like 130 to 60. And so, we bought Chevron on a 5% dividend. We bought a company we like, a small company called Matador on a 3.5% dividend. And then the oil and gas tankers, which we bought some time back. We like those because, particularly TK and Frontline, we think that they'll still be shipping oil, even though there's a soft spot here probably, that the rest of the world is going to be coming out and they'll be using it. We do things like that on the stock side. We do Unilever and we still buy McDonald's. There's an AbbVie we just bought, maybe 6 weeks ago. We added to our silver stock, Pan American Silver, here about last week or so. When they get in where we feel like they're cheap enough, then we buy them, and we have a number of companies we look at. And when they get to a zone where we can viably say, okay, look, you know what, this company's going to do well the next 5 years, because we try to hold things long term. In other words, more than 5 years. Microsoft's one of those companies we've owned, like I said, a long time. The only company, really, that came out of the tech bust of 99 to 01 or 02 and actually went to a new high. A lot of those companies never made it. You take that group, but they did. They changed horses, changed a lot of things they were doing, changed business models, and so they've done really well. We still look at them, though, on the basis of cash flow. And right here, we're not going to be buying tons of Microsoft. We own it much, much cheaper. But on the long run, it's a good company, but some good companies are just too expensive. The rest of the tech group is still fairly expensive, too. So we're particular about where we buy those. I think you're getting more and more from solar. I don't think you're getting as much from wind. But oil, when you went through this green area, it really, people got away from it. I think they're going to realize, and you're starting to see it. I mean, you look at in the Wall Street Journal about General Motors, like, hey, we're going to have more fossil fuel cars. We're not selling the EVs. And that's happening all over these companies. And I think you'll be using more oil again. And like I say, it's had a big correction. You just call it 50%. And you got to get in front of this stuff and buy the right companies. And if you buy the companies that pay a good dividend to you, Exxon's another one, you can afford to hold it because, like with Chevron, we get more on the dividend than we get on the Treasury. And so it's that kind of thing you do. You try to get in front of it. And we feel like that's the next move you'll get from oil over the next 12 months. It'll perk up. Well, I think the biggest reason for Exxon is because if you go look at the two primary exchange-traded funds that are oil, then Exxon is a huge holding in both of them. In the same way, so when they buy them, it's the one that gets the kick because it's the largest holding. I'm not saying Exxon's not a good company. I'm just saying that the flow of that is the reason why Exxon gets a kick. We don't really emphasize too many in the small cap area for this reason. They're not liquid enough for us because we have to buy a lot and sell a lot if we sell it. They're not liquid enough. And the other thing is when small caps really do well, when you have inflation really popping real hard, high, because they can adjust a lot quicker. Then we haven't had that. Yeah, it's higher, but it's not to a point where the big companies can't adjust to, and they were able to finance a lot of things at cheaper prices, 3 or 4 years ago. But small caps, I just don't think it's been their day. Now, if you want to own some of them, it's fine. But for us, it doesn't have the capacity for us to own a lot of them. I think people should be aware of this, that if you had a $3,500 gold price and gold corrects to 2,900, let's say, that's fairly normal after you get a really big move in gold. And what you don't want to do in these sorts of things, if you believe in it over the next 5 years, which we do, you don't want to get shaken out on that downtick because you'll start to think, hey, this thing's over. It's going to go back to 1,500. And we just don't think that's going to happen the way the world's structured today. So you could easily get a shakeout more here. And I think people, if you don't own gold, that's probably not a bad time to look at it if it's weakening and look at some of the miners. But one of the things I've always found about gold for us is that you can't really trade it real well. You have to own it. In other words, if you're going to own it, you just own it. It's going to go through times when it doesn't do well for a year or so, 2 years sometimes. But that's why we don't own, the whole portfolio in it, but we have enough. And so that's how we look at it. The main reason we think, and we own the miners, some of them, is that people can now see, before they were saying, hey, these companies are going to make a lot of money now that gold is going to. See, it's a lag period though. Spot price goes up, and then you've got to wait 6 months. Now all of that feeds back into the pricing. So now you're starting to see it. Like if you look at price to cash flow, it's really low relative to where it was, say, in 2011. And so now it's catching up, and people are saying, okay, well, let's just price these things out at $2,800 or $3,000 gold. That's what we do. And they still make a lot of money, a lot more than they've ever made. So, you look at things like that, and you've got a buffer. That's not to say it won't come down some, but it probably is going to do well over the next 3 or 4 or 5 years. The individual investor needs to always remember this. The thing you want to guard against is the big hit, the big loss. And so the way we buy companies, we're not going to lose a lot of money in them because of where we're buying them, And I think the individual investor has to remember, what do you want to look out for? Number one, like Buffett says, don't lose money, and we hate to lose money. And secondly, buy the companies that give you a buffer of safety. And for the next, if it doesn't work, the worst case scenario is it didn't do quite as well as you wanted, you move it on, but you're not buying it at the high end of the range where the next thing that can happen is to go to the low end of the range. Then you're really in trouble.